The differences between two popular investment options, DGRO and SCHD, lie in their underlying indices. DGRO is an indirectly managed ETF that tracks the performance of the Morningstar US Dividend Growth Index, whereas SCHD is a passively managed ETF that tracks the Dow Jones US Dividend Growth Index. In terms of return-based performance, DGRO has a higher return rate, with a 4.57% return since the beginning of the year, compared to SCHD's 2.31% return over the same period. This means that investors can expect higher returns from DGRO, provided the return rates remain constant. However, it's essential to note that these rates are subject to change due to market forces. On the other hand, SCHD has a lower expense ratio, with a current rate of 0.06%, compared to DGRO's 0.08%. Although this 0.02% difference may seem minor, it can result in significant disparities in charges, particularly for large investments. Therefore, SCHD has the advantage in terms of expense ratio. Despite their differences, both DGRO and SCHD share some similarities. Both have experienced a maximum drawdown of more than 30% since their inception, with DGRO witnessing a drawdown of 35.10% and SCHD experiencing a drawdown of 33.37%. Additionally, both ETFs offer a relatively high dividend yield, exceeding 2% of total shares invested. Ultimately, determining which option is better depends on the investor's goals and priorities. DGRO offers better returns, while SCHD has a lower expense ratio. Investors must weigh these factors to decide which option aligns with their investment objectives.